Ryan Lamont is the CEO, the co-founder of Near Vision Wealth Management. So we're going to see this core come down to the lowest since 2021. That's not enough in itself to stop the Fed. But does that bolster the case? The forwards market sees 4 rate cuts next year. Something is very much disjointed at the moment between where we are now on the inflation and where the market sees rate cuts next year.
So first of all, on inflation, we're not screaming victory yet, because let's not forget energy plays a very important role here. Oil is going up again. Oil producers want oil to be high, so this can play a component as well. Prices in certain sectors are still rising, wages are rising, so let's not cry victory yet. Inflation can bounce back up, and we've seen it, history shows us this. On the economic side, again, something is off, as you said, Manis. We've seen the latest numbers in GDP, up 2%. We were very happy, but then we're looking at GDI, which we look at. It's the second side of the coin. GDI contracted by 1.8%. This is a big divergence that we have not seen before.
Okay, and then at the same time, we're looking at some of the forecasts for CPI today, and New Edge has their own view. This is Ben Emmons. We took a key quote out from his latest research. He says the CPI number is going to be soft. Bonds are recoiled by a disinflation buzz that may turn to the specter of deflation. It is fueled by the street looking for a CPI crash, with Goldman Sachs inflation tracker breaking down as used new car prices, travel, and shelter, they are all moderating. If we get the softer print, what does the market reaction look like in your estimation?
Well, on the US side, I think stocks will probably celebrate that, because they would like to see some cuts. It is hurting. It's hurting earnings. It's hurting long duration assets, so tech sector. So I think the stocks will celebrate it. What we're looking at is, because we're not exposed to the US, we just started the position long on the VIX, because the short volatility carry trade on the VIX is dead. So now we're long VIX. We're looking on the other side, actually, on Japan, because Japan here is very interesting.
Well, we started the show, by the way, cross-asset volatility is spiking up, but your bang for your volatility buck on inflation day is less than we've seen historically. Dollar yen is breaking 140. There's the 1 month T-bills, which we'll come back to in just a moment. Dollar yen's breaking 140. Everybody is saying to me now, this is much more a case about prepare for a non-soft landing, and that's why you want to be long yen. Is that a thesis that you subscribe to?
100%. So we've taken profit on a big chunk of our stocks, the Japanese stocks. We're still long a number of Japanese stocks that are dividend paying: Sony, Mitsubishi UFJ, Japan Tobacco, etc. 3 to 3.5% dividends.
Right.
What we've lost in July in drop in stocks, we've gained in Japanese yen.
Okay.
So we're keeping these stocks because they pay dividends, and we're going to make up for it in basically in the appreciation of the yen, which we expect to happen.
We have a new note out from BlackRock as well. They were looking at the sell-off in China. Again, there's clearly increased signals that they may come through with some additional accommodation. Tech has been rallying off the back of that. I know you've been skeptical, but they're saying the rout in China is overdone, and they are keeping their overweight call.
China, we've been, again, on the sidelines. We've taken profit in January, and I said it on the show. We're still on the sidelines because the Japanese have been accommodating or helping in a piecemeal way. We would like to see more systematic support to come back in again. As long as it's piecemeal as it is today, no, it's a no-go. We're seeing deflation. That's quite dangerous.
Where do you want to be in a deflationary way? I mean, we spent the past 3 years talking about inflation spiral, inflation out of control. You want to buy tips, you want to buy gold, you want to buy Bitcoin. Where do I prepare for a disinflationary world? Because it looks as if it's coming. So where do you want to be? Where's the biggest return in a disinflationary world?
Well, deflation will be coming. So it's long volatility. It's grabbing these opportunities in fixed income where they are at the highs at the moment, because obviously rates will drop in a deflationary environment. and picking up really very solid companies that are dividend paying and playing on the FX as we're doing in Japan.
Are you tilting more defensive then within Europe, say? I'm looking at perhaps some of the traditional Swiss heavyweights like your Nestlé's or your Roche for that matter?
Absolutely, we're exposed to these. We're positive on the CHF, on the Swiss franc, and we're seeing a very nice rally in the CHF, and we continue to hold them. On the more European side, we're holding very opportunistic, again, dividend-paying European stocks, but again on the defensive side, not aggressive. We're much more aggressive in emerging markets at the moment, GCC, ex-China, Turkey. We're looking at what's happening. There's a big U-turn there. The Western support can pick up Turkey, so we're looking at the case at the moment.